The Dhandho Investor. By Mohnish Pabrai. The word Dhando is derived from the Sanskrit meaning actions that create wealth. The Dhandho investors are those people who create wealth with very little or no downside to their capital money. In this book, the author Mohnish Pabrai starts with the success stories of 4 investors who made fortunes with low risk and high return approaches. Then the author explains 9 principles that will make us successful stock market investors, which he called Dhandho investors. The stories of 4 Dhandho investors described in this book are Papa Patels, Manilal Chaudhari, Richard Branson, and Lakshmi Mittal. Papa Patel's success story. Patels are an ethnic group from Gujarat state in India. A significant number of the Patels were migrated to Uganda in the late 19th and early 20th centuries. After living long years in Uganda, the Patels were forced to leave the country because of the Uganda government's new rule imposed on non-Africans in 1972. Some Patel families moved to the United States as refugees with little money by leaving all business in Uganda. Among many Patels, Papa Patel was also moved to the United States in 1973 with his family. Because of the 1973 oil crisis in the United States, the motel businesses ran with low occupancy. Many motels were foreclosed by banks or sold for very low prices. The Papa Patel purchased one of these motels of 20-room capacity with far less than its actual price using 10% cash, and the remaining as a bank loan. Maintaining the motel with his family members, Patel provided the rooms at far less cost than their competitors. By doing so for an extended period, Papa Patel and his group became one of the most prominent motel groups in the United States, with more than $40 billion in the motel assets. Manilal Chaudhari's success story. Manilal Chaudhari is also an Indian from the state of Gujarat. He moved to the United States with his brother's help. After moving to the United States, Manila got a job at a gas station. Working long years at the gas station, he and his brothers bought houses and small businesses like gas stations and laundromats. He searched for nearly 3 years to buy a motel at a discount price. In 2001, due to the 9/11 incident, the motel industry was distressed. Manila grabbed the opportunity to buy a motel at far less than the original prices using pooled money from his family and friends. By working full-time on the motel for about 4 years, he ran the motel in profits, and the motel price doubled. From there, he was able to grow his motel empire to greater levels. Richard Branson's success story. Most of us know Richard Branson, a British business magnate, entrepreneur, investor, and author. In 1984, Richard Branson successfully ran the music recording and distribution business. He was approached with a business plan to start a business-class airline between London and New York. Though he was entirely new to the airline business, he understood that starting it was far less risky. He leased a 747 jumbo jet, hired a few staff, advertised in the newspaper, and sold tickets. With little effort, the business went successful, and now it is well known to everybody as Virgin Atlantic Airlines. Lakshmi Mittal's success story. Lakshmi Mittal, an Indian businessman, ranked 3rd wealthiest human in the Forbes magazine in 2005. He is also known for consolidating weak and fragmented businesses. Mittal started his business career in 1976 with a steel mill in Indonesia. When the Kazakhstan government could not pay its gigantic Kermet steelworkers, Mittal stepped in to acquire it far below its original price. Mittal retained steel mill employees and turned it into a profitable business within a few years. A similar attempt was made by Mittal for the Romanian Sidex steel plant also. The 9 principles of Dhandho Investor. After these business people's success stories, the author explains the 9 basic principles essential to becoming a profitable investor or the Dhandho investor. The 9 basic principles are: 1. Investing in an existing business. 2. Investing in a simple business in an ultra-slow change rate industry. 3. Investing in a distressed business in a distressed industry. 4. Investing in a business with a strong moat. 5. Investing when the odds are awesomely in our favor. 6. Investing in arbitrage businesses. 7. Buying a business that has a margin of safety to our capital investment. 8. Investing in a low-risk, high-uncertainty business. 9. Investing in a copycat business rather than an innovative one. 1. Investing in the existing business. We can build our wealth by purchasing an entire business like Papa Patel or investing our money in the stock market. We can get a tremendous advantage in investing our money in a stock market that lists existing businesses rather than buying an entire business. For instance, we can invest in a fraction of a few businesses through the stock market with whatever money we have. Moreover, we don't have to take care of those businesses as Papa Patel did. 2. Investing in ultra-low slow change rate businesses. Though buying a business in the stock market would be easier, buying a business below its intrinsic value is always important. The intrinsic values can be understood with the help of inflow and outflow cash discounted at a reasonable interest rate. Suppose we can't understand a business simplified, it would be better to ignore that business and move on to another. 3. Investing in a distressed business in a distressed industry. Stock prices are mostly replicating the underlying fundamentals. In other words, the stock prices are primarily equal to their intrinsic values. However, the stock prices always deviate from intrinsic values because of the human emotion-driven pricing procedure. For example, bad news about a particular company makes most stockholders sell the stocks at meager prices. We can buy stocks below their intrinsic values by finding such distressed businesses in a distressed industry. One can figure out such troubled companies from negative news clips, weekly summaries of stocks, filling reports of public and institutional investors. 4. Investing in business with a strong moat. Suppose a business can provide long-term profits with its competitive advantage over its competitors. In that case, such business is said to have a solid moat. The author suggests investing in stocks of a business with a strong moat. Examples of businesses with deep moats are American Express, Coca-Cola, BMW, Citigroup, and many more. The balance sheet, income, and cash flow statements can provide whether a business has a strong moat or not. The moats of all business eventually disappear in 40 to 50 years. So, the author suggests considering the 10 years investing period while purchasing the stocks of a company with a solid moat. 5. Investing when the odds are awesomely in your favor. Temporary distress in a particular industry can lead to a profound reduction in companies' stock prices in that specific industry. Suppose we can notice one of such businesses within our understandable limits whose stock prices are below its intrinsic values. In that case, we can consider that particular stock odds are in our favor, and we can invest heavily in it. While investing, the percentage of the money you can invest in such stocks can be understood with the help of the Kelly formula. The author suggests the book, Fortune's Formula by Williams Poundstone for more details on the Kelly formula. 6. Investing in arbitrage businesses. Suppose we could profit from a tiny difference with the simultaneous buy and sell of a particular asset in different markets. It is called arbitrage investing. The author recommends investing in arbitrage businesses with the considerable duration and width of the spread. 7. Investing with safety to your capital. Suppose one could get a stock at a more significant discount to intrinsic value. In that case, the return is higher with a lower risk to the invested capital. The author says that most top-ranked business schools believe that the higher the risk, the higher the return, and vice versa. It is always recommended to keep a safety net to the capital investment. Such safety can be attained once we find discounted stock prices during heavily distressed periods. 8. Investing in low-risk, high-uncertainty businesses. The prices of stocks generally collapse due to high risk, low uncertainty, or high risk, high uncertainty or low risk, high uncertainty or low risk, and low uncertainty situation of the business. Most stock investors prefer to invest in low risk and low uncertainty businesses. However, a business's future performance is uncertain and the invested capital is at low risk. Such investments can provide better profits. 9. Investing in copycat businesses. Most of the leading businesses like McDonald's, Microsoft, Xbox, Sequel, Walmart, and many more were successful by simply copying the other businesses' ideas. The copycats always have the flexibility to expand their business to maximum limits, leading to more profits than innovative businesses. Buy and sell strategy. A well-understood business with a strong moat, minimal downside risk, and a stock price of less than half of its intrinsic value for 2 to 3 years is worth buying. After holding the stock for 2 to 3 years, it cannot be sold at a loss if we can determine that the current market offering price is less than the current intrinsic values. However, the stock can be sold at a loss if we are sure that the current stock price is higher than the present and future intrinsic value for 2 to 3 years. In the author's opinion, 2 to 3 years is sufficient to determine whether the purchased stocks are in loss or profit and decide to hold or sell them. Final thought. The author suggests that you can't pick stocks on your own, you can buy index funds. However, the author also says that the magic formula of Joel Greenblatt, the author of the little book that beats the market, can offer superior performance than the index funds. By deep diving into the Value Investors Club, Value Line, Outstanding Investor Digest, portfolio reports, Guru Focus websites, subscribing to at least any one of the business publications like Fortune, Forbes, Wall Street Journal, Barron's, and Businessweek, we can improve our stock picking strategy for maximum gains.